Hate doing cardio? Try brushing and flossing your teeth. I'm not talking about building up a sweat. I'm talking about building a healthier mouth for a healthier heart for a healthier you. Smile Generation trusted dentists look at your care through the lens of the mouth-body connection because what happens in the mouth plays a critical role for the rest of your body. To find a dentist near you committed to treating all of you, visit smilegeneration.com/confidence today and live longer, healthier, and happier with confidence unleashed.
You know what it is. That's right. It's time to talk money with your money nerd and financial coach. Now, tighten those purse strings and open those ears. It's the Money Talk with Tiff podcast.
Hey everyone, I am so excited because I have LaDarris Hunt on the line, and LaDarris is here to talk to us about life insurance. Now, you might be saying, well, Tiffany, we have talked about life insurance so many times here on the podcast. However, we have not done a compare and contrast of different life insurance options. So, hey, LaDarris, how are you?
Hey, Tiffany, thank you for having me on the show. I'm really excited to have this spirited conversation today.
Yeah, and I'm glad to have you here. It's been a long time coming, and I follow you on Facebook, and you're always posting some really good gems. So I'm glad that we can make this happen.
I'm thankful for the opportunity.
All right, so let's just hop right in. First and foremost, let's start with the basics. What is life insurance?
So life insurance, by definition, is essentially a transfer of risk. So you transfer the risk from yourself to the insurance company. So it doesn't matter if it's home, auto, commercial, life. It's basically just, hey, I no longer want to have this risk in my household. So let me transfer it to the insurance company and let them manage and handle that risk.
I love how you just broke that down in very simple terms. Is just transferring risk, and the risk is of you dying.
So in regards to life insurance, yes. So the risk is if you're dying, right? So if you die, you pass away early, then and you are financially responsible for your spouse, your children, your household, we can transfer that risk from the household to the insurance company, meaning the insurance company will provide at a minimum 10 times your annual income to help subsidize your household while you're gone.
Gotcha. Okay, so we understand what life insurance is. Let's get into the two main types of life insurance, which is whole and term. So first and foremost, what is whole life insurance?
All right, so whole life insurance is essentially, think about it, it's a contractual guarantee, right? As long as you make your premium payments to the insurance company, they are contractually guaranteed and contractually obligated to pay your family a death benefit when you die, right? Conversely, with a term policy, it's there is, think about renting insurance, right? You're basically renting coverage for 10, 20, or 30 years at a coverage amount of typically 10 times your annual income. And again, it's not a permanent solution. It's just temporary because a lot of times most individuals will not be financially responsible for their children for the rest of their life. So they may only be responsible for 20 years, 25 years. And at that point, they no longer need to have 10 times their income when they pass away. It will more than likely just be a need of final expense. So again, whole life, which is a permanent policy, contractual guarantee to provide a death benefit when you die. Term is a temporary income replacement for when you die. So again, if you die within 10, 20, or 30 years, the insurance company will give you a death benefit. But if you outlive the term, then you will not get a death benefit. Or your family will not get a death benefit.
Gotcha. Okay. So whole is generally speaking like whole life, like your whole lifetime for the most part. Mm-hmm. And then term is only for a certain amount of time. And then once that time is over, that's it. You have to get either another policy or something else or just remain uncovered.
Right. Well, not uncovered. So what happens is typically with the term, one of two things happens. It annually renews, but it renews at a higher premium amount. Right. So, for instance, you could have a 30-year term and you're paying $600 a year for 30 years. but you're in year 31 for that same amount of coverage, that $600 payment may be $1,800 for that first year. And then it continues to go up every single year to the point where you make the decision, well, I can no longer afford this payment. Or at the end of 30 years, you can say, you know what, let me find a permanent policy to cover me, because I no longer, again, may not have the coverage need that I had with the term. And now I'm just looking for something for final expense to pay for my burial.
Oh, so with term, you can keep it longer than the term, but it's like you're locking in that premium for a certain amount of time. It's pretty much how to look at it.
In the beginning, you're locking it in. So it's kind of, think about it like a lease, right? We're leasing an apartment, and most leases are 12 months. At the end of the 12 month, one of two things happens. You renew the lease, or you cancel it, or you move. And if you renew the lease, typically the landlord has the authority to increase the rent, right? So term is the exact same way. At the end of the 10, 20, or 30-year time period, the insurance company has the right to increase the rate, and that right is on an annual basis. And at some point in the future, as you get older, your mortality charges increase, so the rate increases. So the insurance company has the right to continue to increase the premium to a point where you say, you know what, Tiffany, I can no longer afford this premium. I need to cancel this policy.
Gotcha. Okay, so somebody listening might be like, okay, I understand the differences. I understand what life insurance is. I understand the difference between whole and life. Now, how do I choose what's best for me? Like, they both sound like pretty similar options. I mean, I'll be covered until I die, or for a certain amount of time, and then my family gets the benefit. But what is the best option for me, generally speaking? Because I know that's a very nuanced question.
Absolutely. So generally speaking, when it comes to life insurance, you can design it in two ways, right? We're going to talk about specifically death benefit, right? So for a term policy, if I am married and I have children, and let's say I make $50,000 a year, then at a bare minimum, to replace my income for 20 years, I'm looking at $1 million policy. Again, because it's all focused on replacing my income if I die prematurely. Conversely, with a whole life, if let's say I'm 20 years old, I don't have kids, I'm not married, but I want to set aside money for final expense or leave to a charitable organization, I can do that with a whole life policy, right? Because I've mentally told myself, when I die, I want to leave $50,000 to my parents or my nieces or my nephews to cover my expenses, my final expenses when I die. And I can only do that with a permanent policy, because a term policy will eventually expire. So the younger you are, it's probably better for you to have a whole life policy. So typically, like from age 1 to 25, a whole life policy would be the optimal plan. But once you turn 25 and you start having children, husband, wife, other financial obligations, you should look at a term policy to cover your financial obligations to those other parties.
Yes, I love that. And, that tracks with my experience as well, because I think I bought my first policy when I was 21, 22, somewhere up in there. But I already had a child. And I was pregnant, my second, maybe? I can't remember. However, it was very cost efficient still to get a term policy at that point. And my thought process was like, okay, Tiffany, if you get like a 30-year term, in 30 years, you'll be like 50 something. And I'm like, at that point, everybody should be grown. And nobody should be really depending on me. My house should be paid off. I was thinking about all of those different things. And I was like, I should be okay. And I should be able to self-insure by that time. So that was my whole thought process when I got term.
Self-insure with your investments. So your 401k, your IRA, your taxable brokerage account, all of those should be fully funded by the time you're 55. So in theory, you would not need to have permanent coverage.
In theory, yes.
Mhm.
But we all know that sometimes our plans and
And
everything.
it does not always work out that way, unfortunately.
Exactly, exactly. Okay, so if someone's listening, let's say they're 34, single, 3 kids, and they're like, I don't have any coverage whatsoever, they should probably go for term or whole
Absolutely.
term.
That should be the first conversation is because of your children, your financial responsibilities to your children, you should absolutely have a term policy in place to cover your income.
Gotcha. Now, at what point does term start getting more cost prohibitive than whole, or does that ever happen?
So it doesn't really happen. But as you know, as you get older, no matter the product, as you get older, the cost continues to go up. And then with term, depending on the carriers, we have some carriers that will limit your ability to get access to term between 65 and 75. They kind of limit how much term you can have, or even if you qualify for term. And a lot of times at that age, you probably don't want, you don't need term anyway, because you're more than likely not responsible for any children or spouse. You're in a transition stage where now I need to start focusing on my final expenses, making sure that there's money set aside for when I die to cover my final expenses. So you really don't want term after age 65. And that's probably one of the reasons why a lot of carriers kind of cap it at 65 or 70, because the need is not there.
Gotcha, gotcha. And I hear people talking about cash value. So is cash value available with whole life and term, or which one?
So cash value is not available for the traditional term product. Now, there is a product called return to premium, and that does have cash value, but you cannot access it. It's basically just there, and that once your policy expires in 20, 30 years, they pay you back all of your premium. But as far as with whole life or permanent, yes, it does build cash value. Now, let's be clear. Within a whole life product, you can design the product in two ways: for death benefit and cash accumulation. Both policies build cash value, but the cash accumulation design is a more efficient design. It's actually the number one priority of that policy is to be a cash accumulation policy. Whereas when you design a whole life policy for death benefit, the number one priority is to provide a death benefit. So there's a very distinct difference between the two. And a lot of people really don't understand that there is a difference. They think of whole life as all of them are the same. They all build cash value. And that's actually not the case.
And I'm glad you mentioned that, because you just learned me something today. Because I was like, because, when you hear people talking about, like, let's say infinite banking or being your own bank or what have you. And, that's when you let the cash value build up, and then you can take it out, kind of borrow against it or what have you. And I'm like, but if you paying all this premium and it's only getting like your cash value is like 100 after like year 5. Now I'm just over exaggerating, but you get my point. That I'm like, how are people making this work? But now it makes more sense to me that there's different products that do accumulate faster than the typical whole life policy.
That is correct. Not only is it different products, but it's actually different carriers. So when you're focused on cash accumulation within a whole life product, you want to make sure that you're working with carriers that are mutually owned, that pay their policy owners a dividend. Conversely, you have companies that are not mutually owned, so they're owned by stockholders, and those companies pay their stockholders a dividends. So when you're searching for a whole life policy specifically for cash accumulation, you want to focus on mutually owned carriers that pay dividends. And those policies, again, the primary focus is cash accumulation. The death benefit is just there to satisfy the IRS requirement that you have to have a death benefit in order to take advantage of the tax codes that the IRS has for life insurance. But they're not purchasing the policy for life insurance. They're purchasing the policy for the cash accumulation.
And see, y'all, this is why I say, because I just learned another thing right there. But this is why I say always get with someone that knows what they're talking about, for one, but also is independent, because you as an independent agent, you can shop multiple carriers. Whereas if someone wants to go to, let's just say, just because they're coming up, they not paying me for this, Northwestern Mutual, then, they only have Northwestern Mutual products. And so going to an independent agent, now you can shop different carriers and different companies and get, the best deal.
Absolutely. Absolutely. Like, I'm a firm believer of the independent agent model, and that having someone that can shop around with 50 different carriers is better for you, the client, because that individual does not work for the carrier, they work for you.
Exactly. So I think that's a great way to end it. I have one more question. I know you might not be prepared for this one, but it just popped in my head. What is the craziest life insurance related story that you can think of in your career?
The craziest life insurance story. So, one of my in my journey of finding a mentor, I ran across an older gentleman, and he talked about what sparked his interest in get involved with life insurance. And he talked about two separate cases where the individual, one family member came to him. They had a policy for 30 years, and the husband needed to access money from the policy to pay for his wife's burial. And after paying into the policy for 30 years, he only had about $15,000 in the policy that he was able to cash out to at least 10,000 of it to pay for his wife's burial. Conversely, later on that year, he had another client that came in and was interested in seeing how much cash value he had in his policy that he had been paying in for 30 years. He was tired of paying the premium. He just wanted to know what was the available amount. And that person had about $100,000 in his cash value. Now, the only difference between the two individuals, because they had the policy for the same amount of time and they were paying pretty much the same amount of premium, but he said the biggest difference was the first person had a policy with a company that was a stock-owned company, and the sec that did not pay dividends to the policyholder, but paid it to the stockholders. And the second person had a dividend-paying whole life, where the company was paying the dividends to the family member, to the policyholder. So you had one person that had one family that had $15,000 in cash value, and another family that had $100,000 in cash value. So as you can see, even though it's the same product, whole life, because of the different carriers and how they pay their dividends, impacted the family and their eventual death benefit that they will receive from the insurance company. So what he said, once he found that out, it changed his whole mindset on life insurance, and he focused more so on offering dividend paying whole life when it was necessary for his clients.
Wow.
So that story for me, it was like eye-opening, because I know one of the biggest problems in the African American community, and I won't be long in telling this, but a lot of our grandparents and great grandparents were sold whole life insurance from a stock company. So they were paying for 30, 40 years and getting $9,000, $10,000 death benefits, right? Conversely, in other communities, paying the same amount of premium for the same amount of time, they were getting $100,000, $200,000 in death benefit. Now, when we talk about generational wealth, if one family is only getting $10,000 when their matriarch passes away, and the other family is getting $200,000 when their matriarch passes away, that has a huge impact in our ability to generate and create generational wealth. So that's why I'm very much so a proponent of working with the right agent that selects the right carriers for each different product.
Yes. And I love that you mentioned that and brought that up, because when my late grandma passed away back in 2022, she had insurance. She had life insurance. But when we went to, see how much it was like that's it? Like, and we know she had been paying for years. And that was all that was in there. So, you know, it really made me more aware of people can be companies can be very predatory in this industry. And then also why it's so important to make sure that you work with someone that's not predatory and that's actually on the same side of the table as you. So with that being said, if people were interested in learning more about you, or how can they get in contact with you?
So I have a website, LaDarrisHunt.com. That's LaDarrisHunt.com. You can also find me on Facebook, LaDarris Hunt, and Instagram as well, and on LinkedIn.
All right, perfect. And I'll make sure I have all those links in the show notes for our audience. So thank you so much again, LaDarris. I will continue to follow you on Facebook and interact with you. So definitely check him out. He posts some really good information, really good stuff. And I appreciate you being on the show today.
Thank you for having me, Tiffany.
All right.
Take care.
You too. Bye.
Thank you for listening, joining, and being a part of the Money Talk with Tiff podcast this week. You can check Tiff out every Thursday for a new Money Talk podcast. But if you just can't wait until next week, you can listen to previous podcast episodes at moneytalkwitht.com or follow Tiff on all social media platforms at Money Talk with T. Until next time, spend wise by spending less than you make. A word to the money wise is always sufficient.